OG John AG here. Shout out to my brother Malcolm Young, who kept it real in the comments. Please add in some version of press the like button to your statement. Some of us are working with ADHD. Keep forgetting simple things like that unintentionally. I feel you on that, brother. But real talk. This channel was never built on begging for likes, subs, or chasing algorithm games. This is traders and investors breaking down markets for traders and investors. Real people, real analysis, zero hype. All logic, cold, hard breakdowns. The likes and comments, that's just my way of checking if the squad is tuned in or if I'm talking into the void. The real ones show up, drop a word, an emoji, whatever. And that's how I know my people are locked in. And yeah, Economic Ninja episode is coming real soon. Me and the team put in serious hours on this one. It's going to land different. Stay ready. Appreciate every single one of you that ride without me having to ask. Y'all the reason I keep going. And yeah, Economic Ninja episode is coming real soon. Last nail in the coffin type energy. Me and the team put in serious hours on this one. It's going to land different. Stay ready. Appreciate every single one of you that ride without me having to ask. Y'all the reason I keep going. I'm looking at a forecast that just hit my desk and I had to read it 3 times to make sure I wasn't misreading the numbers. Bank of America just raised their gold price target to $6,000 per ounce by mid-2026, not $5,000, which is where most of Wall Street was clustering their estimates just weeks ago. $6,000. Asian guy here, and here's why this matters more than you might think, especially if you're watching silver. As of this morning, January 24th, gold is trading around $450 per ounce, and silver is at $103.93. The gold to silver ratio currently sits near 48.1, the tightest it's been since 2013. Now, if gold moves to $6,000 and that ratio holds anywhere near current levels, we're talking about silver prices that most people think are impossible. But before we get to the math, let me show you exactly what Bank of America is seeing and why their analysts just moved the goalposts on the entire precious metals complex. The Bank of America report led by Michael Whitmer, their head of metals research, lays out a case that goes beyond just calling a higher number. They're pointing to what they call unorthodox U.S. fiscal policy as the primary driver. Here's what that means in practice. The United States is running massive budget deficits with debt to GDP ratios at record highs. When governments print money to cover deficits, the purchasing power of that currency declines. Gold historically serves as a hedge against currency debasement, which is exactly what we're seeing play out in real time. BofA forecasts that the average gold price will hit $4,538 per ounce for 2026, with potential to test the $5,000 milestone. But now they're saying conditions could push it to $6,000 by spring. Ed Yardeni from Yardeni Research is even more aggressive, calling for $6,000 as his year-end 2026 target. JP Morgan has gold averaging $5,555 in late 2026, with a long-term target of $6,000 by 2028. Goldman Sachs sees $4,900. Morgan Stanley forecasts $4,500 by mid-2026. What's significant isn't just the upward revision. It's the clustering of major institutional forecasts in the $5,000 to $6,000 range, when just 2 years ago, most of these same institutions were calling for $20,200 to $20,500. Now, let's talk about what's driving this. First, central bank gold buying has transitioned from sporadic purchasing to consistent accumulation. According to multiple reports, central banks are buying gold at the highest volumes in decades. In 2024 and 2025, official sector purchases set new records. Central bank gold reserves have now surpassed their holdings of U.S. Treasuries in many jurisdictions. Yet the average gold allocation is only about 15% of total reserves. Bank of America's modeling indicates that raising the average gold allocation to around 30% would fully optimize reserve assets, suggesting central bank buying could persist for years. This is structural demand, not cyclical. These are sovereign nations diversifying away from dollar dependency. And that trend accelerated after the US and EU froze Russia's reserves in 2022. When central banks see currency risk and geopolitical tension, they buy gold. And unlike private investors who might sell into rallies, central banks accumulate for strategic reasons that aren't price-sensitive. Second, investment demand remains dramatically underallocated. BofA notes that gold allocation within the professional investment sector, including high net worth individuals, is only about 0.5% of portfolios, far below the model-optimized level of around 30%. Michael Whitmer stated that just a 14% increase in investment demand could push gold to $5,000. We're already above that level, and if institutional allocations start moving toward even 5% or 10%, the demand surge would be massive. Third, production from major North American gold miners is projected to decline by 2% in 2026, while average all-in sustaining costs are expected to rise by 3% to approximately $2,600 per ounce. That creates fundamental support. Miners can't flood the market with new supply even at these elevated prices because of declining ore grades, rising energy costs, and long lead times for new projects. Now, here's where it gets really interesting for silver. Bank of America isn't just bullish on gold. Their report specifically emphasizes that silver's upside potential far exceeds that of gold. They're forecasting silver to average $60 per ounce in 2026, but they note the market is in deficit and could see significant volatility. We're already at 103, well above their forecast, which tells you how fast this market is moving. But let's do some math. The gold to silver ratio currently sits around 50-1. Historically, this ratio has ranged between 50 to 80 for most of modern history, but in eras when physical stockpiles were abundant and demand was stable, the ratio traded closer to 33 to 35. Right now, stockpiles are gone. The silver market has been in structural deficit for 5 consecutive years. According to the Silver Institute and Metals Focus, the structural deficit in 2025 reached approximately 95 to 117 million ounces, marking the 5th consecutive year of deficits. Total silver demand reached around 1.24 billion ounces in 2025, according to multiple industry sources, while total supply, mine production plus recycling, came in at about 1.14 billion ounces, leaving a meaningful annual shortfall that continues into 2026. Let me show you what this means numerically. If gold hits $6,000 per ounce and the gold to silver ratio stays at 50-1, silver would trade at $120 per ounce. If the ratio compresses to 40-1, which is well within historical norms, silver hits $150. If it reverts to the 33 to 35 range that's been observed in previous eras, you're looking at $171 to $181 per ounce. Now, I'm not saying that's guaranteed or that it happens overnight, but the mathematics are straightforward. When gold rallies this hard and silver is in a structural supply deficit with exploding industrial demand, the ratio doesn't stay wide. It compresses. And when it compresses, silver outperforms gold on a percentage basis by massive margins. Mike Maloney has been highlighting this dynamic extensively, noting that silver could outperform gold by 6x or more in certain scenarios. Let's talk about why silver's deficit is real and why it's not going away. Total silver demand reached 1.24 billion ounces in 2025, according to multiple industry sources. Total supply, including mine production and recycling, amounted to about 1.01 billion ounces. That's a deficit of over 230 million ounces, equivalent to the entire annual output of Mexico, the world's largest silver producer. Industrial fabrication demand hit 665 million ounces, down 2% from the prior year due to economic uncertainty and thrifting efforts as prices spiked. But here's the critical point. Even with industrial demand declining slightly, the market is still in massive deficit. Why? Because investment demand has surged. Philip Newman from Metals Focus reported that inflows into silver ETFs increased by 187 million ounces in 2025. That's institutional and retail money flowing into physical-backed products, removing metal from the available supply pool. Now, let's break down the industrial demand story because this is where silver differs fundamentally from gold. Between 50% and 60% of annual silver consumption comes from technology and manufacturing sectors. Solar panels require approximately 20 grams of silver per unit for conductive efficiency. Electric vehicles use up to 2 ounces of silver in sensors, wiring, and power modules. Electronics and semiconductors rely on silver's unparalleled conductivity. Medical applications use its antimicrobial properties for instruments and coatings. The International Energy Agency estimates that by 2030, the solar and EV sectors alone will consume half of global silver output, leaving minimal supply for jewelry, coins, and investment bars. The Silver Institute shows solar consumption hit a new all-time high in 2024 and surged again in 2025. By 2050, cumulative solar demand could equal 85 to 98% of today's known silver reserves. And unlike copper or aluminum, silver has no viable substitute in most of these applications. But here's the part that changes how I interpret everything we just discussed. On January 1st, 2026, China implemented new export restrictions on refined silver that are already sending shockwaves through global markets. Under the new policy, only large state-approved companies are allowed to export silver, and only after obtaining special government licenses. Firms must meet two stringent conditions: an annual production capacity of at least 80 tons of silver and special regulatory approval. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users and refineries. China currently controls between 60% and 70% of the world's refined silver supply. Even a partial restriction instantly creates a global supply shock. This move mirrors China's earlier strategy with rare earth metals, where export controls were used to secure domestic industrial advantage and global pricing power. The immediate impact has been visible in the physical market. BMI emphasizes that since January 1st, Beijing's restrictions have put additional pressure on inventories in important storage locations such as London and Zurich. Leasing rates for silver temporarily spiked to over 8% on a one-month term. Those kinds of movements indicate that metal is more difficult to obtain in the physical market in the short term, and that bottlenecks in financing and delivery are becoming more noticeable. When lease rates spike like that, it means there's a scramble for physical metal. Industrial users who need silver for production can't wait. They'll pay premiums, lock and forward contracts, and secure supply at almost any price. That's exactly what we're seeing. Multiple reports indicate that industrial users are signing multi-year supply contracts at prices 20% above current spot, which doesn't make business sense unless they expect future availability to be severely constrained. Now, let me address the bearish case because there are legitimate risks here. First, if the Federal Reserve takes a hawkish turn and raises interest rates or holds them elevated longer than expected, that's a headwind for non-yielding assets like gold and silver. Bank of America specifically notes this as the key downside risk to their $6,000 gold forecast. Higher real interest rates make bonds more attractive relative to metals. Second, industrial demand could face headwinds if recession indicators materialize or if manufacturing slows significantly. The Silver Institute forecasts industrial demand decline 2% in 2025 due to global economic uncertainty stemming from tariff policies and geopolitical tensions. Third, at elevated prices, there's always substitution risk. Companies will look for cheaper alternatives if silver becomes too expensive, though silver's unique properties make this difficult in most applications. Fourth, if investment demand reverses and ETF flows turn negative, that could pressure. Fifth, higher prices do incentivize mine production increases and recycling, which could eventually ease supply tightness, though this takes time. But after presenting those bearish factors, look at what just happened this week. Silver hit an all-time nominal high of 10,345 on January 23, 2026. That's not a typo. Silver has never traded higher in nominal dollar terms in history. The previous peaks were $49.45 in 1980 during the Hunt brothers squeeze and $48.70 in 2011. We're now 111% above the 2011 high. And this rally is happening while industrial demand is supposedly declining and production conditions are improving. That tells you the investment demand and supply constraint story is overpowering everything else. When you have a structural deficit for 5 consecutive years, declining above-ground stocks, export restrictions from the world's largest refiner, exploding investment flows, and a gold rally pushing towards $6,000, the bearish factors become mechanisms that delay the move, not invalidate it. Let me show you what Wall Street is projecting for silver specifically. BNP Paribas suggested silver could climb as high as $100 per ounce by the end of 2026. We've already exceeded that in January. Bank of America sees silver averaging $60 for the year. We're at 103. Krupp recently forecast $100 by March. We hit that weeks early. Alan Hybard from Gold Silver is on record saying he expects silver to perform better in 2026 than it did in 2025, when it gained 147%. He wouldn't be surprised to see the price increase by over $100 per ounce from current levels, putting it above $175. That's not a random guess. That's based on the structural deficit, industrial demand trajectory, and the gold-silver ratio dynamics we've been discussing. When you have major banks forecasting $6,000 gold and the ratio is compressing, $175 silver isn't extreme. It's arithmetic. Here's what this means for physical holders and traders. If you're holding physical silver, you're positioned in a market where supply is structurally constrained, industrial demand is growing at double-digit rates in key sectors, investment flows are accelerating, and the largest refiner just locked down exports. That's a setup where prices can move fast and far. If you're trading silver futures or mining stocks, understand that volatility will be extreme. The CME recently shifted to percentage-based margin requirements, which means as prices rise, the cost of leverage rises proportionally. This changes the dynamics for paper traders, but doesn't affect physical holders at all. If you're looking at silver miners, focus on those with low all-in sustaining costs and production growth potential. Though recognize that mining stocks carry different risks than physical metal. The key variable to watch is whether Bank of America's $6,000 gold forecast materializes and how fast it happens. If gold moves to $6,000 by spring 2026, as some forecasts suggest, and if silver maintains even a 50-to-1 ratio, you're looking at $120 silver within months. If the ratio compresses to 40 or lower, which has happened in every major precious metals rally in history, silver could exceed $150. The gold-silver ratio has already compressed from over 100 in 2020 to around 45 today. That's a 55-point move in less than 6 years. Historical norms suggest it can compress further, especially when silver is in deficit and gold is in a structural bull market driven by currency debasement and central bank buying. Here's the final piece. This isn't just about price speculation. This is about a fundamental repricing of physical scarcity versus paper promises. For decades, the COMEX and other exchanges have set silver prices through futures contracts that are settled in cash, not metal. But when China restricts exports, when industrial users lock in multi-year supply contracts, when lease rates spike to 8%, when COMEX inventories drain by tens of millions of ounces in weeks, the physical market is asserting pricing power. The paper market can delay that process through manipulation, through margin increases, through regulatory intervention, but it can't change the fact that there are 1.24 billion ounces of annual demand and only 1.01 billion ounces of supply. The math doesn't work. Something has to give. Either prices rise enough to destroy demand through substitution and demand destruction, or industrial users get priced out, or new supply comes online fast enough to close the gap. None of those scenarios are bearish for silver prices in the near term. So when Bank of America says gold is going to $6,000, they're not just calling a number. They're validating a thesis about currency debasement, fiscal policy gone wrong, central bank accumulation, and investment demand reallocation. And if that thesis is correct for gold, it's even more powerful for silver because silver has the added dynamic of industrial scarcity. Gold doesn't get consumed. It sits in vaults. Silver gets used in solar panels, electronics, EVs, medical devices, and it's gone. It doesn't get recycled efficiently because it's dispersed in tiny amounts across millions of products. That creates permanent demand that can't be satisfied by above-ground stocks because those stocks are already depleted after 5 years of deficits. If gold hits $6,000 and silver stays below $100, the ratio would be over 60-to-1, which would make silver historically cheap relative to gold at precisely the moment when silver's fundamentals are stronger than they've been in decades. That mismatch doesn't persist. Markets correct, and when they correct in commodities with tight physical supply, they correct violently. We saw it in 2011 when silver went from $18 to $49 in months. We're seeing it now with silver going from $30 to $13 in weeks. The difference this time is that the structural deficit is real. The industrial demand is accelerating and the investment flows are just beginning. If Bank of America is right about $6,000 gold, the silver story isn't just bullish, it's potentially explosive. And that's not hype. That's just mathematics applied to a market in deficit with surging demand and constrained supply.